Gold isn't heading toward the $3,200. Gold is acting like $3,200 is already behind the market. And a whole class of people still arguing about that number are using last cycle's map, while the plumbing underneath this one is forcing a very different outcome. The conflict is simple. Officials want you to believe geopolitics stays compartmentalized, rate policy stays in control, and the move in gold is just emotional froth that will fade the moment a headline cools. But the hidden mechanism that matters right now is not the headline at all. It's the price of time in the gold market, the way immediate metal is being valued versus future delivery, and what that does to dealers, shorts, and reserve managers when liquidity thins. And by the end of this, you'll have a concrete next 2 weeks checklist, the exact kind of levels that tend to trigger forced buying, and the single math line that tells you whether the next violent dip is a reload or the start of a real unwind. Because if one level breaks, the math changes. Let's address the elephant up front. If you're still thinking of $3,200 as some far-off target, you're anchoring to a psychological number that mattered when gold lived in a lower regime. In the first weeks of January 2026, gold has been trading in the mid-4,000s per ounce, and it's coming off a year where the metal didn't just rise. It repriced what normal looks like. That matters because it changes how you interpret every pullback, every spike, and every "this is the top victory lap" you're going to see after the first ugly red candle. In this regime, $3,200 isn't the ceiling. It's a stress test floor, an old reference point that becomes relevant again only if something breaks hard and forced selling hits everything at once. And that's exactly why the title still matters. When two geopolitical flashpoints ignite at the same time, the market's base case shifts from gold rallies on fear to gold stays bid because the system wants a neutral settlement asset. That's where the real pressure starts. Now take the two crises setup the way the market takes it, not the way social media takes it. The Middle East risk channel is the inflation and supply chain channel. It's energy, shipping, insurance, and a constant threat of disruption that raises the probability distribution of outcomes, not just the most likely outcome. India-Pakistan risk is different. It's a tail risk channel with a nuclear shadow, a miscalculation premium, and a regional confidence premium that doesn't wait for confirmation. When those two are live at the same time, something changes. Portfolios stop thinking in terms of one hedge for one headline and start thinking in terms of what holds value if multiple pipes clog at once. And when that happens, gold isn't trading like a commodity, it's trading like collateral. But that's not the part that matters most. The part that matters most is that gold is not a single market. It's a stack of markets layered on top of each other. Physical bars moving through refineries and vaults, forwards and swaps in the wholesale system, futures on exchanges, options sitting on top of futures, ETFs absorbing and releasing inventory, and central banks taking metal out of the tradable float entirely. When price jumps, people argue about fear. When spreads change, the system is telling you about availability and financing. And spreads are where the truth leaks out. Here's the simplest way to see the hidden detail. Gold normally lives in contango. Futures prices are higher than spot because of cost of carry. You're paying for storage, insurance, financing, and time. In a calm world, time is cheap and predictable. But in a stressed world, time becomes the product. If the forward curve flattens or inverts relative to what rates and carry would suggest, it means somebody values metal now more than metal later, or somebody's willing to pay up to avoid being short physical through a delivery window. That shows up as compressed forward premia, strained spreads, and sometimes higher lease rates, the effective interest rate you pay to borrow gold. And when borrowing metal gets expensive, it's not because the market is bored. It's because somebody with a balance sheet is trying not to be trapped. The next detail is what flips the whole setup, because the calendar is the catalyst. Early January is not just a new year, it's a reset of risk budgets, a rebalancing of portfolios in a period where liquidity can be thinner than people expect. It's when funds decide what they will and won't carry. It's when new hedges get placed. It's when dealers look at their option books and realize which strikes are crowded and which levels will force them to hedge in a hurry. And it's when a geopolitical spark can turn into a gap because there aren't enough willing sellers on the other side of the trade at that moment. That's why you see these moves cluster around calendar edges. Year start flows, month-end reweights, quarter-end constraints, and of course, option expiries and delivery windows that create mechanical buying or selling pressure. If you're trying to understand why gold can jump when the news looks minor, start looking at the calendar instead of the narrative. Because if this one level breaks, the math changes. Now, zoom in on price behavior without worshiping the chart. Charts don't predict. They reveal where decisions get forced. In a market that's been living around $4,300 to $4,500 with sharp spikes, the fight isn't about whether gold is bullish. The fight is about whether pullbacks find buyers quickly, whether old highs become support, and whether the market is building higher lows that squeeze shorts and force dealers to chase. The reason that matters for the $3,200 conversation is psychological and mechanical. Psychologically, $3,200 is the old regime's line, a number that a lot of people still think of as expensive. Mechanically, if gold ever did plunge toward that region in this new regime, it would likely be because of a broad liquidation event, margin calls, forced selling, and a violent dash into cash. But here's the irony. Those are exactly the episodes where gold can snap back the hardest once the forced selling clears, because the underlying demand for neutral collateral doesn't disappear. It just waits for the blood in the streets. But that's not the part that matters. The part that matters is what these two crises do to the market's probability tree. In the Middle East channel, you're not just pricing a single event. You're pricing an increased chance of sustained disruption, energy volatility, shipping constraints, and an inflation impulse that can reignite at the worst possible moment for central banks. When energy risk rises, inflation expectations can lift, and even if nominal yields move too, real yields don't always do what the textbooks say, especially when credibility is being tested. Gold lives and dies by real yields, and the dollar, yes, but it lives and dies by expectations about what policy can actually contain. And when you have repeated shocks, markets begin to doubt containment. That's when gold stops needing bad news to go up. It just needs uncertainty to stay up. In the India-Pakistan channel, markets price speed. A report of a cross-border incident, drones, smuggling routes, a local clash, doesn't have to become a war to matter. It only has to create the perception that escalation risk is non-zero and miscalculation is possible. And when two nuclear-adjacent powers share a border with history and domestic political pressures, miscalculation is the tail that wags the dog. Investors don't size that risk neatly. They hedge it, often with simple instruments, gold, dollars, and volatility. That's why the risk premium can build even in quiet weeks. And that's where the real pressure starts. Now let's make the mechanism concrete. Paper gold versus physical gold. Paper gold, futures, and some forms of synthetic exposure can move fast because it S-leverage and it S-liquid. Physical gold moves slower because it's logistics, refining, vaulting, and finance. But the moment people start worrying about settlement, counterparty risk, or delivery timing, physical demand becomes a constraint on paper pricing. Not because they ran out of gold, but because the cost of sourcing and financing a deliverable metal rises. That cost shows up in spreads and lease rates. A bullion desk that is short metal in the wholesale market and long futures might be hedged on paper, but if they have to source physical through a tight window, they can be forced to pay up. And when a few desks start paying up, it doesn't take long before the whole complex reprices. Price is the billboard, spreads are the supply chain, but that's not the part that matters. Because the market structure above futures can turn this into math. Options do not just reflect expectations. They can force the underlying to move. Here's the clean version. When lots of call options are bought near big round number strikes, dealers who sold those calls often hedge by buying futures as price rises because their exposure becomes more sensitive. The delta increases. If the market is in a positive gamma environment for dealers, their hedging can dampen moves. But if the flow is one-sided and the strikes are stacked, price approaching those strikes can force dealers to buy more into strength. That's reflexivity. It's not conspiracy. It's risk management. And in thin liquidity, hello, early January, that hedging flow can move price more than people expect. The move isn't emotion, it's math. And if you want to know whether a squeeze is brewing, you don't just watch spot. You watch how price behaves around key strikes and old highs, and you watch whether dips are being bought instantly or whether they bleed. Because if one level breaks, the math changes. Now stack the proof. Not one argument, 5 layers minimum. Layer 1, the term structure signal. In normal carry conditions, the curve should reflect financing costs. If you see curve compression that doesn't match the rate backdrop, something is pulling on immediate demand. It can be hedging for delivery. It can be tightness in the leasing market. It can be a sudden scramble for collateral. The key is not to obsess over one day's print. The key is to watch the direction. Is time getting cheaper or more expensive? Layer 2, the financing-lease signal. When lease rates rise, it means borrowing gold is more costly. That tends to happen when there's increased demand to borrow metal or when balance sheet constraints make lenders demand more compensation. Again, it's not magical scarcity. It's a price for immediacy and credit. Layer 3, institutional flows. In 2025, physically backed gold ETFs saw massive inflows, with reports describing record inflows for the year. That matters because ETFs absorb physical metal into a wrapper that retail and institutions can buy with one click. When inflows are persistent, they remove float. And when float is removed, paper shorts have less room to breathe in a pinch. Layer 4, official sector behavior. Central banks have been persistent buyers in recent years, and the logic is straightforward. Diversify reserves, reduce dependency on a single issuer, and hold an asset that doesn't need a promise to be valuable. When that bid is present, gold rallies are less likely to be purely speculative blow-offs and more likely to be structural repricing. The market can have sell-offs, absolutely, but the demand base is different. Layer 5, the street symptom. In tight episodes, you'll see premiums and local distortions, physical buying pressure in hubs, changes in availability, faster turnover, sometimes unusual behavior in coin and bar markets. You don't need perfect data to use this as a confirmation layer. You just need to know what you are looking for. When the screen says one thing, but the street is paying up, the stress is real. Layer 6, because you always want one more, the chart structure itself. Not for prophecy, just for behavior. Breakouts that hold, retests that get defended, and higher lows that keep compressing are signs of pressure building. Failed breakouts with ugly closes and heavy selling are signs the market needs to reset. That's how you keep your head while everyone else is staring at the headline. But that's not the part that matters most. What matters most is why these two crises amplify the same underlying narrative: trust. Markets don't panic because they're dramatic. Markets panic when they don't know who is solvent, who is liquid, and who can settle. A prolonged or widening Middle East flare can raise energy volatility and inflation uncertainty, forcing central banks into harder choices. An India-Pakistan flare increases tail risk hedging demand and can pressure regional capital flows and currency sentiment. Together, they're a stress test for the everything is fine story. And gold is the asset that benefits when everything is fine becomes everything is complicated. Now, credibility check. There are counterpoints, and if you ignore them, you'll get emotionally wrecked by the first sharp pullback. Counterpoint 1, supply responds. Mining output can rise when prices are high, and recycling can increase as people cash in. That doesn't flip the market overnight, but it's a real force that can cap rallies or slow them. Counterpoint 2, geopolitics can cool fast. A de-escalation headline can nuke volatility in hours, and if positioning is crowded, that volatility crush can take gold down hard, even if the underlying reasons for owning it remain. Counterpoint 3, policy can surprise. If real yields spike, if the dollar strengthens sharply, or if liquidity tightens abruptly, gold can whip around violently. And it will, even if your thesis is right. Especially if your thesis is right, because the market's job is to shake out weak hands before the next leg. And that's where the psychological shield matters. Here's the viewer psychology shield, because this is how they steal your decision making. The market will use 3 tricks. Trick 1, headline whiplash. You'll get an escalation alert, price spikes, then talks resume, price dumps, then new incident, price spikes again. That isn't random. It's the perfect environment to get you to chase highs and sell lows. Trick 2, the fake breakdown. Price will slice a well-known support level intraday. Everyone will declare the bull market dead, and then it will reclaim the level by the close. That's a stop run. It's not personal, it's liquidity. Trick 3, the confidence trap. Someone will speak with absolute certainty. Gold is going to X tomorrow. And when reality doesn't T-match, you'll feel stupid and emotional, and you'll do something impulsive. The antidote is to separate trend signal from noise. Trend signal is structure. Higher lows, defended retests, improving spreads, persistent inflows, and real yield behavior that stops fighting the metal. Noise is one headline, one candle, one influencer. If you can't tell which is which, you'll be traded by your own feelings. And that's where the real pressure starts. So, what matters this week, right now, today, this month? Levels and confirmations, not dreams. In this regime, you want to think in zones, not single numbers. You want a near-term support zone where buyers repeatedly step in, often near prior breakout areas or last week S pivot. You want a resistance zone near the recent highs where sellers have been able to cap moves. If gold pushes through those highs and holds, that's confirmation behavior. If it pokes above and immediately slams back below with heavy selling and a stronger dollar and rising real yields, that's a warning. The exact numbers will differ depending on whether you're watching spot, futures, or your local currency, but the logic is universal. The market tells you what it wants by how it behaves after the breakout, not during it. During a breakout, everyone is excited. After the breakout, you find out who is forced. Because if one level breaks, the math changes. Now the 2-scenario lens, because this is how you stay finance credible and keep yourself from getting married to one storyline. Scenario 1 is the controlled pullback and retest. Gold sells off on a de-escalation headline or a rate surprise, volatility spikes, social media screams, and then price stabilizes above the most important support zone. It chops, it frustrates, and it rebuilds. In that scenario, you want to see dips bought quickly, you want to see the market refuse to give back too much, and you want to see the curve and financing signals not collapse. That's the reload setup. Scenario 2 is the continuation squeeze. Liquidity stays thin, more calls get bought, dealers hedge, shorts cover, and price gaps higher in a way that makes dip buyers angry because they don't get filled. That scenario tends to happen when the market is positioned wrong and the catalyst hits during a fragile liquidity window. It feels unfair. It is unfair. That's the point. And you manage it not by predicting which scenario will happen, but by having rules for what confirms each. But that's not the part that matters most. What matters most is the why now trigger and what it forces participants to do. Early January forces funds to reevaluate exposures. It forces risk managers to tighten or loosen limits. It forces dealers to rehedge option books after year-end roll and new demand. And it forces the global system to stare at 2 live geopolitical risk nodes at the same time and decide how much insurance it wants to carry. Insurance demand is not polite. It's urgent. It shows up as buying in gold, in volatility, and in anything that can be liquidated later if needed. And when that insurance demand meets a market where a lot of float has been absorbed by ETFs and official buyers, you get a different kind of price behavior. It's not a straight line. It's a stair-step with violent shakes. That's why you can be right and still feel wrong for days. And that's where the real pressure starts. Now let's bring it back to the promise. What to watch next, and how $3,200 fits into this without diluting yourself. The reason $3,200 is still a useful anchor is because it represents the old psychological ceiling that becomes a new kind of benchmark. How far the market would have to fall to convince the world this repricing was a mirage. In a world where gold is trading far above that, a drop toward that region would not be a normal correction. It would be an event, a global dash for cash, a credit shock, or a policy mistake so sharp it forces liquidation across assets. If you ever see gold cascading toward that number, the question isn't, should I buy because $3,200 was the target? The question is, what broke, what's being liquidated, and is the move being driven by forced selling rather than fundamentals? Because forced selling ends. Fundamentals persist. If you can tell the difference, you stop being the liquidity for somebody else's margin call. Here's your next 10-day checklist, the kind that keeps you grounded when the candles start screaming. 1. Watch real yields. You don't need to be an economist. Just ask, are yields rising in a way that should hurt gold, and is gold refusing to go down? That's strength. 2. Watch the dollar. A raging dollar rally can punch gold even in a bullish regime. If the dollar is firm and gold is still holding up, that's another tell. 3. Watch curve shape and financing chatter. Whether the market is pricing time normally, or whether there's stress in the entas now versus later relationship. 4. Watch institutional flow behavior. Are ETFs still absorbing, or are they leaking? 5. Watch the geopolitical calendar. Weekends, policy meetings, known deadlines, and any window where liquidity is thinner and gaps are more likely. 6. Watch how price behaves after it hits a level, not on the way to it. Break and hold beats spike and fade every time. And 7. Define your invalidation. Not a vibe, a condition. For example, repeated failures at the highs plus breakdown below the key support zone plus a sustained surge in real yields is a different regime than a one-day headline dip. That's the line between trend signal and noise. And if this one level breaks, the math changes. Now, the subtle truth that most people miss because it doesn't sound exciting, the market doesn't have to believe in India-Pakistan escalation or Middle East escalation to keep gold bid. It only has to believe that the probability of bad outcomes has risen enough that holding some neutral collateral is rational. That's it. And when probability shifts, you don't need certainty. You need positioning. You need flow. You need mechanics. That S, why the most dangerous mistake you can make is waiting for a confirmation in the form of a perfect headline. The market moves before the headline is tidy. Then the headline arrives to justify the move. Then the crowd arrives. Then volatility punishes them. Then the trend continues. That cycle repeats because human psychology repeats. Don't be the repeat. If you're still here, you're not looking for hype. You're looking for mechanism. That's the identity edge. Most people want predictions. Predictions are cheap. Mechanism is what keeps you calm when price tries to bully you. So as this plays out over the next week or two, don't let a violent dip convince you the thesis died. And don't let a vertical spike convince you risk disappeared. Both are traps. Use the 2-scenario lens. Use the checklist. Respect the fact that even a correct thesis can deliver brutal drawdowns and ugly shakeouts. And remember the hidden detail. When the market starts paying differently for gold now versus gold later, it's not gossip. It's the system revealing stress in the only language it can to fake for long. Stay focused on that, and you'll stop reacting to noise and start reading pressure. And if you want to build a community of people who track the spreads, the flows, the calendar, and the mechanics, people who get emotionally hijacked by every candle, then you already know what to do. Stay close, keep your process tight, and in the comments, tell me the one level you are watching that would force you to change your mind, because that's how you stay honest in markets like this.